$100 in a move that didn't surprise anyone but Nigerian Prince scam victims. What? Papa Powell Noriega and the Cartel have increased the price of the brick. The streets are drying up quicker than two-parent homes during the 50-year war on drugs. Much like the war on drugs, the main victims are the addicts, who need special help, not the pushers of the drugs themselves. As Americans try to shake off their addiction to cheap money, they are left wondering when they'll get their next fix. And you, yeah you are wondering how this will affect you in the real estate market and affect your ability to provide for your families. We'll give you a step-by-step process to navigate this market. What's up, everybody? I'm Sean McMurray, co-host of BPM RIA Online, and this is Mr. $250 million in real estate transactions, my mentor, my good friend, president and owner of BPM RIA, Anish Dave.
Hey, this is Anish Dave, president of BPM RIA, and it's good to see you guys this afternoon.
What's the data? This past Wednesday, the Fed announced the fourth consecutive jumbo interest rate hike of 75 basis points. We've seen the largest rate hike in 28 years. According to Greg McBride, Bankrate chief financial analyst, they, the Fed, were late to acknowledge inflation, late to wind down stimulus, late to start raising rates, and late to ramp up rate hikes in a meaningful way. They're still playing catch up against inflation that continues to run near 40-year highs. I think the only thing they haven't been late for is messing up. I can only imagine they will overcorrect and throw us into recession and then start flooding the streets with that cheap cash again, and we just repeat the cycle over and over again.
I can't live like this. The same routine over and over.
This is next level dependency, like straight toxic. When do we break the addiction? Mortgage rates have increased at the fastest pace on record, hitting 20-year highs, says McBride. What McBride is really saying is mortgage rates are the Wolf of Wall Street on a Quaalude and crack binge high.
The cerebral palsy phase.
So when does the madness stop?
Well, it seems it's a mystery to all of us.
According to the U.S. Central Bank, rates are expected to peak at 4.5 to 4.75% in 2023. Goldman Sachs economists are locking in a 4.75% to 5% lift by 2023. There's a 2 in 3 chance that the economy will contract in the next 12 to 18 months, according to 14 economists surveyed by Bankrate. A Bloomberg survey of 42 economists has a recession probability at 60%, although a Bloomberg probability model projects a 100% chance of a recession by October 2023. Anish, the next year isn't looking so hot. What is your take on the Fed raising interest rates and the likelihood of it continuing?
Yeah, so you know what, Sean? The Fed's raising those rates, and you know what? I'm actually a little worried too, but not really, because guess what? I'm using other people's money.
Pro tip. There's a common misconception that the Fed rate directly affects the mortgage rate. Although influenced by the Fed rate, mortgage rates tend to track the yield on 10-year U.S. Treasury bonds. As investors see or anticipate rate hikes, they make moves which send yields higher and mortgage rates rise. For example, this past week, before the Fed officially raised rates, the market was pricing in a more dovish Fed. Mortgage rates actually dropped slightly. I learned something today. What will get more expensive? Credit cards, which is a bit frustrating. Forgive me for the tangent, but sidebar. Times are hard for all of us right now. For those of you who were fortunate enough to establish a rainy day fund despite inflation and the crazy market, chances are you've been living off those reserves to make ends meet. If you've already exhausted those funds, you are now putting everything on credit cards. Guess what? Those credit card rates are going up. The Fed is literally trying to drain your savings account.
You're so dramatic.
Fair enough, but here's what Esther George, the president of the Federal Reserve Bank of Kansas City, had to say about it. We see today there is a bit of a savings buffer still sitting for households that may allow them to continue to spend in a way that keeps demand strong, she said. That suggests we may have to keep at this for a while. So,
Read between the lines, bitch.
yeah, the Fed messed up the economy, and now you either stop spending altogether or we drain your account until you can't spend anymore.
Well, fuck you very much.
Papa Powell Noriega.
So, Sean, you know what? Auto financing rates are going up. Guess what? I'm not buying a new car. That's a depreciating asset. Who cares if the rates are going up on that end of it? That doesn't make you any money. What we're really worried about is housing. So, hey, don't buy that spare sports car. It's not the right time right now.
Mortgages. We've discussed that above in our pro tip.
Yes, Sean, you know what? So what? There's variable rate loans, and sometimes it is going to get more expensive, but it's really short term. So if it's short term, it's not that big of a deal. We were used to getting super low rates when it was almost free money. Now we got to pay to play a little bit. That's not a big deal for us.
What does this mean for Florida and the real estate market here?
Yeah, so Sean, you know, what does it mean to us here in Florida? It's still a great time. And actually, you know what, we haven't really even talked about it, but rates going up is a good thing for us because it gets sellers scared a little bit and they want to sell faster and they're saying, oh my God, there's not enough buyers. We actually use that as a negotiating tool to get better pricing.
How do you use this information as a real estate investor? Now look, I've been a little passionate in this video because let's face it, Papa Powell Noriega, well,
They screwed the pooch partner. Plain and simple.
because he messed up so bad, you and me suffer. Although the beauty of working with people like Anish and BPM Ria, the current situation matters, but it doesn't stop us from progressing. We adapt, we overcome, we do not focus on the problem, but on the solution. With that being said, here's how you use this information to make better and informed decisions as a real estate investor. Number one, be patient. Take this finger and this hand and do this. Ignore the noise and be patient. The best time to invest is today. Let's talk in the sidebar. Prior to today, the best time to invest was when rates were at 2%, then 3%, 4%, etc., etc. Can you imagine that talking heads earlier this year were telling you not to buy properties when rates were at 4 and 5%? Those rates look like deals at today's plus 7%. To add to that point, home appreciation, despite increased mortgage rates, has still managed to appreciate by 17.67% nationally as of quarter two. Back to the regularly scheduled program. Apply multiple strategies. Log into your lead generating software, Zillow, or in our case, Reafax. Type in a zip code you are interested in and search for rentals. Find the contact info and pick up this and do this. Let's talk in the sidebar. You have to apply multiple strategies. If you've been more traditional with your approach to real estate investing, i.e. obtain a mortgage and buy a property, high mortgage rates. Instead, you will find homes that are for rent and you will use short-term rentals as your strategy. Whether you use arbitrage or co-hosting, you add doors to your portfolio at a fraction of the cost and commitment. At most, you'll need first, last, and deposit and $8,000 to $12,000 for furniture. Back to step 3. Identify funding sources. In our last video, we talked about signing up for our mentorship program to gain access to 100% funding for all your deals. In this video, you are doing something different. Pick up this and call mom and dad. If they are local, take them out to dinner. But if not, order food from their favorite restaurant and have it delivered.
It does help grease the wheel, Larry.
Since you are using arbitrage or co-hosting, you only need $23,100 in our example. You're going to borrow this money from mom and dad, and you will pay them interest on the deal. You're keeping the money in the family, and they are helping you continue your investing career. Number 4, be conservative with your numbers. Depending on your market, short-term rentals are still very lucrative, but we are seeing a slowdown. When running your numbers, ensure to run different projection models to account for multiple scenarios. You want to keep your occupancy rate at about 70 to 80% for maximum profit. If it makes sense at your launch price, just make sure you are conservative with your numbers. Anish, what do you think? Any other tips that you can give our future investors?
Yeah, so Sean, you know what? Don't be worried about the Fed. It's, you know, we, in our industry, we kind of joke about it. It's our favorite villain, and it's our job to be the superhero. And superheroes always win. And the idea is, what else are you going to do, right? You know, you're going to sit on the sidelines and, you know, cry all day and eat milk and cookies and poor me, or you're going to put your big pants on or big boots on and get out there and start building your business. I mean, we do live in the greatest country in the world where we could actually leverage other people's money and make your dreams happen.
If you're expecting mortgage rates to come down anytime soon and you're sitting on the sidelines waiting, you'll be waiting for a long time. While you've been waiting, we've been making over $1 million this past year. The best time to invest is today. There is certainly chaos in the market, but following these 4 steps will help you navigate these challenges and reduce your risk. Number 1, be patient. Number 2, identify funding sources or other people's money. Number 3, be conservative with your numbers. And number 4, apply multiple strategies. Anish, final words.
Yeah, finally, what I'd love to let you guys know, the best investment is yourself, right? It's about time you start investing in your future, whether it's education, the things that you really want to do, because no one else is going to do it. And usually, if you do it right, the return is going to be pretty big.
And we're out.